Bob is smiling again.
Okay. So, per usual, I want to talk a little bit about questions you might have from the homeworks and some on the problem set. I have some comments about the homework as well to give you. Then we're going to kind of review some of the information that we dealt with last week about the forward market multiple model, thinking about enterprise value multiples and their algebraic equivalents. We'll then take a look together at three different models, and I'm going to actually split you guys up into three and have each group come to a certain part of the board and work out some information based upon this data that I've got over here on the right-hand side. And you know, work together, and I'll come work with you, and then we'll stand back and look and say, okay, why are they similar? Why are they different? What are we looking at really? And then at that point, we'll then start to look at forecasting revenue. I think we've talked about forecasting revenue a little bit, right? GDP changes, thinking about changes in populations, opening markets and such, as we talked about organic versus synthetic growth, merger acquisition and such. And then we'll look at forecast ratios, which really are a method to help us forecast expenses. Forecasting revenues is, as it turns out, the single most important thing we can do, but if you don't forecast your expenses properly, then your revenue forecasts are meaningless, right? And so there have to be some pretty good standards we can rely on for that. And then we'll look at some capital assumptions that have to be made so that we can forecast some non-expense and non-revenue items like fixed assets and net working capital, so we can forecast free cash flow, right? And then we'll look at some adjustments, and then we'll talk about the next ICP, and it'll be about midnight, we're home. Because there's never enough for us to do on any given Tuesday night. We always have enough. I want to go on record saying you guys got out of here early last week, right?
No.
Yes, I remember. It was like 8:45. Okay.
What are you insinuating?
What I'm insinuating is good luck with that. Questions with, well, first let me make a couple of comments to make some of the questions easier with respect to the homework and the problem set. On the homework, not the practice homework, but the homework, virtually everybody got question 1 wrong because you gave it the right answer. Think about that for a second. So the answer that the quiz showed as correct was $2 off. So everybody got it wrong because everybody gave the right answer. So I went in and I've adjusted all those scores. Okay. Now fortunately those didn't cascade elsewhere. All right. So if you look at your homeworks for virtually everything, including your problem sets, I think everything's current scored. So I went in ahead and scored the last question as well. And then the other problem I saw, and a few of you have talked to me about this, is an issue of how you think about invested capital for these companies. And there's a good rule of thumb that you can just kind of keep in the back of your head, and makes perfect sense. If you are valuing the entirety of the company, then you need to use the entirety of the company's fixed assets for the invested capital. Okay. If you're only valuing part of the company, let's say Mariana's got a company, it's got some legacy assets. It's got a warehouse that it leases out to some other company. It doesn't really use for whatever you do for your business anymore. You used to use it, but you don't anymore. It's got some patents on some technology that you don't use anymore, and so you let lesser companies use your patents and get a little bit of a royalty for that. But you're not a real estate company, and you're not a patent company, okay? But those happen to still be sitting on your books. You probably have some revenues and maybe even some expenses associated with those. Well, if I'm coming to buy your company, Mariana Industries, I'm probably interested in the part of your company that I know. Did you see that she smiled? All of a sudden, she was able to visualize being a global captain of enterprise.
It wouldn't be called Mariana Industries, but yeah.
Okay, I'm sure that's probably true. I just didn't know what you were talking. But she started to visualize it. You can see it by the look on her face. So if I was interested in your company, because of the company I knew, I probably wouldn't be interested in those legacy assets. I couldn't care less about that. So maybe I only want to buy part of the company. Well, in which case, ROIC and everything that it begats, I only want to think about that number as it relates to the parts of the company that I want. So I wouldn't use the legacy assets in the fixed asset part. I wouldn't use the revenues from those legacy assets or possibly their expenses in the EBIT part to get to all my other good numbers, right? But if I'm going to take the whole company, I'm going to take all of these assets, even though some of them might be listed as fixed, operating, and some of them might be just listed as other assets. I'm going to use all of them, okay? So because of that, how you have to think about that, some of you use the wrong fixed asset value because you didn't include, I think there was some land and some mineral rights, so I can't remember what it was. But the key here is we were valuing the entirety of the company. So the entirety of the company's asset base must be included. Otherwise, you get a very skewed read, right? And from what I saw in the homework, the vast majority of the problems were focused on that. Because if you got the wrong invested capital, you got the wrong ROIC. You got the wrong, if you're using the wrong fixed asset base, you got the wrong net capital spending. You got the wrong free cash flow. You got the wrong valuation using free cash flow or using KBD. It cascaded. It was a waterfall. And you were oh so happy. So other than that, what questions do you have about the homework? Really?
Probably the last question. I'm better understanding the KBD model and that specific.
Okay. And that actually is the focus of the exercise we're going to do together.
Oh.
But let me just say, as I scored that through, obviously the free cash flow model and the KBD model only differ in the continuation term, right? They don't differ in the explicit term. When you have to decide what equation you're using to calculate free cash flow, if you're in the explicit period, you're calculating something during the explicit forecast, you always, always, always use free cash flow equals no plat plus depreciation minus change in net working capital minus net capital spending. Okay? Always. And the only time you would ever use the key value driver form of this equation, which is free cash flow is equal to no plat times 1 minus G divided by ROIC, you only use that in the continuation term. And when you use it in the continuation term, it becomes the key value driver model. It's no longer expressly the free cash flow model. I mean, it kind of is, right? But it's not. So what really separates them is this notion of bringing return on invested capital into the equation for value and bringing it in juxtaposed to the weighted average cost of capital and growth and the other inputs, right? But in fact, the reason that the free cash flow model outcome and the key value driver model outcome will differ sometimes, often, isn't because you introduced G, or rather isn't because you introduced return on invested capital. That's actually already inherent in the other models. You just don't necessarily recognize it immediately. It's the G. It's the nemesis. It's that bad mother that sits in the corner, okay, and just drives us nuts. We're actually going to play with that as we do an exercise today, so we can think, okay, how do you get to, how do you try to get a G that satisfies both of those models and brings you a good equality? What else? So here's the thing. I don't think that we're going to introduce any new meaningful model forms.
Thank God.
Good for you. I will talk a little bit about some assumptions that have to be made so that we can use our existing models with forecasted values. We're going to talk about those tonight. I will talk about how you organize information, but we now kind of pivot from having to just beat ourselves about the head and face with these numeric models to now thinking about the inference of the outcomes from these models and inference of changes in the inputs that begat different outcomes. Okay, so I know it's really tempting to just take, like a lot of you do, really well-disciplined form, lots of notes, and when you do that, sometimes it's hard to be talking and thinking about what's going on. But I need you to try as much as you can to be at a point where you can talk and think about what's going on. And if you're not at that point yet, then over the next week, before we are in class again, try to capture some time with me. Or if you're not comfortable capturing time with me, or if you just can't have them because of schedules, then grab 2 or 3 people that you think have it going on and just talk about what's happening in the model forms, and try to do that without equations, just like human beings instead of automatons. You'll find if you can do that, and it's hard because we become so reliant on equations. We want to use them. They are our friends. They're comfortable, right? Except for Chris.
Pardon me?
Doesn't want any more of them. I love them. I just, yeah, I know that's part of it. Okay,
It
so.
needs to be simplified in Excel. That's what it needs
Pardon?
to be. It needs to be simplified in Excel.
Yes, and you can do that if you know what you're doing.
Like I even put them in a folder.
I'm so impressed. I'm so impressed. Okay, so before I start digging back into the forward marketable discussion, what else do you want to talk about?
Can you go over, I know in the WhatsApp you recently said that the operations IC and financing IC can be, should be the same in this case, but as we talked, it can be different.
Mm-hmm.
Can you just clarify that?
Sure. And I think somewhere, or maybe multiple times I've said in this class, you should virtually always use the invested capital from the operations approach. So let me just put a couple of real quick numbers on the board. So let's assume I've got current assets at 1,000, current liabilities at 800, fixed assets that are operational at 10,000, and fixed assets that are non-operational, so maybe they're legacy or they just exist for some other reason, at 2,000. And let's say I've got no plat at 3,000. So if I'm going to use the operations approach, I can value the entirety of the company, and when I do so, I'm going to see that I've got $12,000 in fixed assets, and I think it's $200 in net working capital. So my investment capital from an ops approach for the whole company is going to be $12,200, right? And if I was looking at the invested capital from the financing approach, it would be the exact $12,200. Okay. I haven't put the total debt and total equity up here, but it would be. Kim?
Would there, in what case would you use one or the other?
I'll come to that in just a second. Yep. But what if I don't want to buy the entire company? Here we have Lewis and Associates, and Lewis and Associates has 2 very distinct arms. They've got a manufacturing arm, and they've got a design arm. And frankly, I'm not interested in the design arm. I'm only interested in the manufacturing arm. Okay? In which case, I can now parse out
So you're not working.
of the fixed assets that which are part of the manufacturing. And if my no plat was constructed from a well-detailed income statement, I probably can see the revenues associated with the design arm versus manufacturing. I can see the expenses, so I can even get a no plat that is just unique to the manufacturing segment. So I can come up with all of my measures that I use for the manufacturing arm only. Now, what is hard to do is parse out which part of the net working capital is unique to one or the other. I don't know how to do it, in part because I don't know how much of the cash comes from the design versus the manufacturing. I probably could figure out with enough detail what part of the accounts receivable are from one or the other, what part of the inventory is from one or the other, what part of the payables are from one or the other, right? But cash, that's where I just really have a problem. And some of the expenses are going to be shared by them, such as the president's expense and the executive suite and all this overheadish kind of stuff. And because of that, we don't even bother parsing out what happens within the net working capital. We just use net working capital straight across. Okay. Now that may overstate something, but it typically overstates it in a relatively minor way. All right. So I'm telling you, use the operations approach for the entirety of the company when it's the entirety of the company that's at stake. Use the operations approach for just a small part or a big part of the company when it's just a part of the company that's at stake. If it's the entirety of the company, the operations approach and the financing approach will give you the same number. If they don't, run the numbers again. Or look at the balance sheet and the income statement and make sure it all balances. I've actually hit my head against that wall before. And they just, the two invested capitals just did not jive. And what is wrong with my ability to add numbers? Well, all of a sudden I realized that it wasn't me, it was whoever put together the balance sheet. The balance sheet didn't balance. Okay. And sometimes balance sheets don't balance even when the totals on the right and the left are the same number. Because sometimes accountants fudge them and force them into quasi-balance. Okay?
Goodwill?
Pardon me?
Goodwill?
Yeah, maybe that's where it's supposed to be. It's usually improper accounting practices, right? Somebody's not doing it right. And so they know if they publish this thing and you've got two different numbers at the bottom, on the left and the right, and then you see it and you're the CEO, Chris, they know what will be held at. But they also know that you only look at the numbers on the bottom, the left and the right. As long as you see the same numbers, then you go on. So they live to fight another day. So they're going to be the same number if you look at the whole company, but in this case, if we're not looking at the whole company, we're going to see that it's 10,200. And now it's a whole different ballgame. Okay? Does that make sense? It's common for firms to look at the fixed assets and say fixed operating assets and other assets, or long-term assets. Some of these terms are fungible, right? And it's common to see some assets on there that are not expressly valued for their operational expertise. For example, let's assume that Chris has a company, I have a company, and they are the exact same company in almost every way of looking at them. We've got the same size warehouse, we've got the same size manufacturing run, we've got the same customers, everything you can think of, but he owns his building and warehouse and I lease one. Well, we're going to have very different fixed assets on the balance sheet, aren't we? Even if we both own everything inside of it. He's going to have the land and the physical buildings, and I'm not. I'm going to have probably a rent or lease expense that he's not. Okay. Well, in this case, very often we have to think, how do we consider the value of those assets? Do I run the value of those assets just like I run them for the rest of our present value valuation model? Or when I look at the real estate, should I take it at market value of the real estate, just as real estate, and bring in an appraiser. I probably need to do that, right?
What's the benefit in doing that? You just increase your company's value?
Well, the benefit in doing that is now the lease expense that I'm paying and the property ownership that you have at market, assuming my lease is also at market, should balance each other in a present value equation.
But I'm gonna have upkeep on the building, you're not,
Right, but that's gonna be embodied in my lease payment, right?
and I'm gonna have property taxes and you're not.
Well, but that's gonna be embodied in my lease payment. And there's gonna be some depreciation of the building that I'm not gonna have that you are. It's gonna be embodied in my lease payment. So the lease payment, if it's a market lease, which I'm gonna say most leases are market leases, right? Unless they're so old, I mean, I negotiated it 30 years ago, and it's a 50-year lease, and I'm a happy guy because nobody foresaw the increase in real estate that we had, or the little bobble decrease that we had. But so if that happens to be the case, then we're all screwed up. But if it's a fairly current lease and a market value, if I also know the market values of your inputs and outcomes of the property, then those numbers over a period of time should balance each other out. The lease payment that I'm making, the rent payment I'm making, should be a function of that depreciation, that upkeep, that property tax, the market value of the property as such. So they should, over time, looking at them in one unique snapshot just at this moment, two different numbers, right? But over time, they should give us the same outcome, or relatively similar. Does that make sense?
Built into the price.
Built in, it's exactly right. Right. Okay. So we're getting to a point where if I could be the little devil on your shoulder when you're doing this stuff, the thing I would be whispering in your ear is, stop and think. Don't try to remember the memorized thing. Just think. You probably have the answer already baked into the cortex somewhere, okay? You just don't realize it. You just don't realize it. I promise, Adriana, I promise. Okay, all right. Anything else? Okay, so let's talk about market multiples. Without looking at your notes, someone articulate for me. Whoops. That's going to be a problem. Yeah, that might happen. Somebody articulate for me the forward market multiple model. Talk to me about it in English, if you can.
Oh, I would say it's EV over EBIT. But
Okay, well that's the multiple itself,
Yeah.
okay? So there's a whole class of multiples that are referred to as enterprise value multiples. And the two most commonly used are EV/EBIT and EV/EBITDA. And the DA is depreciation and amortization, okay? So earnings before interest, tax, depreciation, and amortization. I strongly prefer EV/EBIT. I preferred it as a practitioner. I preferred it as the one that was examining value of companies for our own funds and our business. I prefer it as somebody that's looking at this theoretically and teaching. But I have to admit that the industry, valuation and corporate finance industry, tends to use EV/EBITDA. Or in fact prefers EBITDA as a measure than EBIT, okay? I don't really know why that is. And every time I talk to somebody about it, I don't get a satisfactory answer from them. I just think it's an accounting outcome that seemingly is important. And maybe because people like to say EBITDA, because they like a rolling off their tongue. EBITDA, okay? So, but EBIT is really that measure that helps me understand how the company's doing income expense-wise without any consideration of how the company's capitalized, without any consideration of exogenous influence of taxes or the different way of calculating taxes, right? But it does have the exogenous influence of depreciation built into this. And maybe that's why so many prefer EBITDA, is because it doesn't have depreciation in it. And we know that depreciation is exogenous. It comes from a table, right? As opposed to it coming from reality.
Well, the money is already gone.
Well, in the EBITDA, the money's not already gone because we aren't considering depreciation, which is why I like EV, or why I like EBIT, because that capital that we are using to create the income that we're talking about didn't come out of thin air. It came out of some capital investment and some human investment, labor, okay? And maybe idea, innovation, technology, etc., right? Please.
So EBITDA is excluding depreciation?
Yeah, so it's going to be
Okay.
earnings before interest, tax, depreciation, and amortization.
Okay.
So it's going to be a bigger number than EBIT, right?
Right.
Right? And I don't like it. I just don't like it. Okay? I don't like people with a full head of hair. I don't like EBITDA. I'm looking at you.
Get a haircut.
No. You know, it's an unsatisfactory measure to me because, and maybe it's the economist in me, because it doesn't give recognition to the fact that that capital equipment or the fixed assets that we're using to create this revenue, they came from somewhere with some expense. And EBITDA doesn't give any nod to that. And so to me, it misstates. Now, the reality is, when you use these things, you don't use them singularly, you use them on a comparative basis, okay? So, and you typically use them in a ratio. So as long as you're doing like for like, it may not be that big of a deal, but I much prefer it, okay? So the enterprise value multiple that we'll talk about, aside from me having shown you a sheet last week that's got a half a dozen of them on it, is we'll use EV, okay? And it's a number, that's all it is. All it is. Gives us some multiple.
Last week you said that like the guys on what's the
Shark Tank.
show talk. They
I'm
wrote-
sorry,
they
did you
wrote-
notice he said that like he'd never watched reality TV? He's never seen it.
I worked in TV, dude. It's,
Okay, I'm just messing with you.
and I don't watch it. But they use the expression that's X number whatever times
Yeah,
earnings, X,
yeah.
like 7 times earnings, in reaction to whatever people are presenting.
Yeah, and as it turns out, they're largely using EBIT. They're largely using EBIT. Yeah.
This is a very basic question, but what do you mean by multiple? Like the word multiple?
It's a ratio. A
Okay.
multiple is a ratio. Okay? And here's a nice way to visualize it. So if I told you that EV was equal to EBIT times some multiple of EBIT, so 2 times EBIT, 4 times EBIT, times some multiple of EBIT, that's a little easier to see it sometimes, right? But to go from here to here, well, this for some of us. Okay, all right. So if we have one Mariana, then that's trouble all by its lonesome, right? If we have a Mariana and a Mariana, that's a multiple of 2 Marianas, and that's double the trouble. It's a multiple.
It's a multiple.
It's a multiple.
Makes sense.
I knew if I used the right language, she'd get it. So, okay. So it's easier sometimes to visualize it like this. And the only difference between these 2 equations is I've divided both sides by EBIT to get this part of the equation.
Can
Yeah.
you use the bottom equation in a sentence?
The bottom equation?
Yeah. I'm serious.
Yes, yes.
Like in English, instead of formula.
Yes.
Yes. Double the trouble equals Mariana times 2,
Oh, okay. That makes sense.
right?
That does make sense.
Cool. You know, I get that some of these things are just too abstract. I really do. I really do. So I appreciate that. And it's, you know, it's kind of like, my work day equals no, I'm trying to find another way of bringing it into it, get it in a sense. My work day equals 60 times the number of minutes an hour, or rather, 60 times the number of hours that I work. I'm stretching here, sorry.
So,
No, but I think we all understand it better
Okay,
now.
good, good.
I think.
Please do.
so when I sold apartment buildings, like some old-time investors would use this similar type of thing. They'd say, how much rent does it get per year?
It's your cap rate, right? Is
Well,
that what
that was
you?
a little different.
Okay,
That was a little more in depth. But the gross rent multiplier,
yes.
so they just say, how much rent does it get per year? So say you got like 120,000. Well, they would multiply it by 10 and say, okay, I'll pay 1,200,000.
Exactly. So rent times 10 or some standard multiplier that I've gotten used to using tells me that I should be willing to pay 1.2 mil for
That's pretty much what you
Okay.
feel is right.
This being some standard multiplier that might be applicable in certain types of real estate. Not all types, right? Because if it's a warehouse, it might be different than if it's an apartment building.
Yeah, exactly.
Right? So it's just a multiplier. It's a scale. Some of you are comfortable with the term scale. Okay? It's a scale. All right? Well, we talked about the fact that we don't necessarily know, just on the surface of things, what the right multiplier scalar should be to value a particular business. So I'm looking at Matt's business. It's an auto parts manufacturing firm. I'm looking at Wes's business. It's a game and entertainment firm. I'm looking at Courtney's business, and it's a travel and leisure firm. And these are three completely different kinds of businesses. And so I can't even think about using the same multiplier or multiple for them. I have to go out and I have to look at what other firms in that industry that have had transactions where we see the enterprise value and we see the EBIT, let's say, and from which we can then see a multiple. Because if we know EV and if we know EBIT, we know the multiple. But very often, if it's a privately held firm, we don't know enterprise value. Well, we may know EBIT, right? But what's the enterprise value? Well, that's what we're trying to figure out. So we go out to the marketplace and we say, okay, a company that looks like this, what is the multiple that I can see for that kind of company as it's transacting? And here Karen's got a company, and Karen's company was $15 million in revenue. And Janet's got a company, and Janet's company was $150 million in revenue. I'm not going to use the same multiple for both companies, even if they're in the exact same industry, because the scale of the two is so vastly different. Even though it looks like apples and apples, it's a Macintosh apple and a Golden Gala or whatever they are. Okay? So I got to think about it. Yeah.
Is the multiple tied closely to like the growth rate?
Yeah. In fact, that's exactly right. And this is actually a point I wanted to end up coming to. So we do this. We do this because we don't know how to assess growth sometimes. Okay, it's a problem for us. We don't know how to get to that number.
So do we generally have, we obviously always have EBIT, but do we generally have the multiple or the enterprise value?
Yes, we generally always have the multiple or the enterprise value.
But which one is the most, like,
Multiples just kind of made up.
Well,
Yeah.
or it's observed from other firms, right?
Compared.
Yeah.
Yeah. So, but unfortunately, unless it's a market-oriented firm, in which case you have economic agents buying and selling stock, preferred and common, we don't know what the enterprise value is, right?
Yeah.
So I would say that for the vast majority of firms that we will deal with, what's more elusive to us is the enterprise value. I can look at 20 other firms that transacted, which means they had some capital investment causing a valuation of sorts to be done, or they're market-based. I can look at those in the same industry and pair this into like for like, maybe dial it up, dial it down, do weighted averages, etc., and I can come up with a multiple. Okay. Or I can recognize exactly what you just said, Matt, and that is that, I think it was you that said it, is that we see growth in this. Okay? So think about this for a minute. And we went through this last week. I know that when I'm estimating the value of something, I am estimating its enterprise value. Okay, that's what I'm after. That which is going to take to acquire the future, or the rights to all the future cash flows, all of them, even the ones that are currently contracted away today. And I can look at this and I can say that equals no plat at time 1 times 1 minus G divided by ROIC divided by WACC minus G. Now, I'm making some assumptions when I use it in this form. I'm assuming that A, this G and this G are the same, which they should be, and they are the growth rate of this no plat, right? And I'm assuming that this growth rate is going to be constant in perpetuity for this asset.
How can you make that assumption?
With boldness and bravado, it's hard to back up.
Right?
Which is your point. I'm going to back away from it in just a second, but that is exactly my problem with just the utility of an enterprise value multiple.
Like I'm thinking of a tractor for a mining operation. It's got a shelf life. You know, it's not going to last forever.
Well, that's right. Well, that's true, but the mining operation may be able to, well, if there's enough stuff in the earth for it to. But the tractor will last forever if there is enough maintenance, upkeep, and if you have a sinking fund to buy a new tractor when this one runs out.
Or if it's not
May not be this tractor, but it's a tractor, right? So that's got to all be inherent in this no plat. Because this is EBIT times 1 minus the tax, which is where we go next. It's EBIT. Well, in fact, I won't do it there, I'll do it here. So what is this equal? EBIT
Seriously though.
times 1 minus the tax. Right? Are we good? Okay. So how do I turn this into an enterprise value multiple? I want to know what this is supposed to be. I divide both sides by E. And I'm left with this. Okay. This is the KVD form of the EV-EBIT multiple. And if we look at this, we can turn it into something that to me is a little more satisfying to look at because I can talk about it in another way. And I can turn it into ROIC minus G divided by ROIC times WACC minus G times 1 minus tax. Do you want me to walk through how we go from here to here? Or are you... Anybody other than Harry? Because I'll do a few individually, Harry.
God, I don't remember algebra from high school.
Let's just take
No, I'm hitting up top.
Let's just take a minute.
That's what you do.
You gotta divide by both sides, multiply by both sides.
Yeah, oh yeah, we're gonna divide, multiply. We're gonna have a great, good old time.
Okay.
Okay.
I get it, it makes sense.
So to get to this point, okay, I'm gonna handle this now. I'm gonna separate the 1 minus T out over here.
Can you use numbers instead of...
Nope. If I use numbers, then it'll mess you up. So I have 1 minus G divided by ROIC, right? In here. So that's the same equation, right? All I did was I moved my multiplier of 1 minus T to the side. I can recreate this part of the equation by saying ROIC divided by ROIC is equal to 1, right? And I can then further say ROIC minus G is divided by ROIC is the same thing.
Don't they cancel out then?
Cancel.
Well, it's not so much canceling. So now, how do I think about this? I can go ahead now and rewrite this algebraically. But I'm going to flip this thing
G
now.
over ROIC.
Okay, so what I had to get here, what was I had 1 minus G divided by ROIC. And I said that that was ROIC divided by ROIC, which is equal to 1, minus G divided by ROIC. So now I have common denominators. And now I can use additive rules and just say ROIC minus G divided by ROIC. So all three of these are the exact same thing. Okay? And now all I have to do is remember some of my rules of products or quotients, and I can then go ahead and say that this is equal to ROIC minus G divided by ROIC here times WACC minus G. Remember, I left this out to the side and never messed with it. This equation is the same as this equation.
What's the benefit of switching it?
What's the benefit of what?
Why would we, I mean, if we're express.
Why do it like this rather than like this?
Yeah.
To me, it makes no difference when you're calculating. None whatsoever. If you calculate it using this, or running it through one of its interim paces, you're going to get the exact same outcome. So the benefit isn't in calculating it, the benefit's in talking about it and visualizing what's at play here. What's at play is this relationship of ROIC and WACC, okay, in the face of growth. That's just a little easier for me to see like this for some reason. It may not be easier for you to see, it's just easier for me to see. There's a primer that I think is posted for this week, maybe it's next week, it's an NYU Stearns primer, and that walks through the paces on this. It wasn't written by DeMotor, who's at NYU Stearns, it was written by a couple of his colleagues. In fact, actually, I think they were grad students, to be honest with you, that ended up staying there for a while. But he goes through, and they prefer this form as well. It's just a little bit more satisfying. Yeah?
I was just wondering, why are we taking into account the tax rate if this formula is before?
This is the tax rate on EBIT. Remember, we started with no plat because we had EBIT times 1 minus the tax, which equaled no plat. Because even though taxes are exogenous, which I think maybe is the point you're about to make, they are an exogenous reality. We can't avoid them. And when trying to do like for like and match things up apples to apples, we want to look at the tax rate on EBIT so we can think about how this would be taxed regardless of any exogenous decisions other than the tax decision itself.
So, in other words, if you omitted that tax component, you're essentially risking what that liability is going to be in the future. You're looking to you're going to pay for something. Because you know that you're going to do taxes on whatever it earns.
Yes, but in this case, there's something else going on. If my measure was enterprise value divided by no plat, if that's the enterprise value measure that I prefer, then I wouldn't have 1 minus tax or EBIT, I'd have no plat. Okay? It's all a function of how these variables are constructed or identified and what they mean. Well, that's the most, okay, that's the one I want to spend time on, right?
Can I try explaining it in English?
Sure.
So your enterprise value equals basically what you're trying to do. You're trying to take your earnings before interest and taxes and multiply it by the interest that, like, the return on invested capital is basically what the seller wants for it minus the actual gross. So you take the difference there and you multiply it by that, and then you divide it by that interest. The reason why you're adjusting it was WACC is because you're discounting.
Let me take it to a more fundamental level.
Okay, thank you.
Then you can go where you're going. I think this makes sense to all of us. The value of my firm is a function, or it's a byproduct, of what my firm earns, what my firm receives in returns on capital I invested, what I pay for that capital, and the taxes that are charged. That's pretty simple, right? All the rest of this is simply algebraic to reflect standard accounting and financial accounting principles. All the rest of it simply does that. The value of an asset is the function of what the asset earns, what the investors or creators of the asset invested in it, the capital they put in, and the return they get on that, and what it costs them to have it there, and then affected by some tax because it is the unfortunate reality of society. Does that help? Yeah, Matt.
The reason the tax rate is in there, or the taxes are in there, is because everybody gets taxed at a different rate, or businesses could be taxed at a different rate. Because couldn't you just drop that off and still get a similar type number?
We could get rid of the tax if what we were doing is EV no plat.
And what's remind me of the relationship between no plat and EBIT here?
So, say again, please.
The relationship between EBIT and no plat.
No plat is equal to EBIT times 1 minus the tax. Okay? And I think to answer the rest of your question, Matt, I think it's a recognition that if we have some cash flow, profit, if you will, I'm going to use profit in a very, very loose sense here, then we live within a governmental unit that requires some of that from us. There is little getting around that. And the way that you managed it versus Brandon versus Adriana are probably different because of how you chose to capitalize the asset, which was an exogenous decision, because of other transactions that you've entered into that might have given you tax losses or credits, which were maybe totally irrelevant to the operation of this asset. So it's got to be there because there's it and death are the only two things we can't avoid. But I don't want to use the regular tax rate on taxable income. I don't want to use the tax rate that we get when we look at taxes paid divided by taxable income. I want to use a tax rate on EBIT. Right? It brings it to the most central and common point that we would all have to experience if we made simplifying assumptions. What do you think, Darren?
I'm still processing something you said 2 minutes ago.
Me too. Me too.
So I'm kind of 5 minutes behind.
It's all right. This is simply an algebraic formula multiple. So now, think about this. Trying to think how to say this so it doesn't lose it. Do I know what my no plat is?
Yes.
Income statement. I know what my no plat is. Income statement and balance sheet, do I know what my invested capital is?
Yes.
Do I now know what my return on invested capital is?
Yes.
Okay, good. You check those off. I know these numbers. All right?
Yes.
Do I know my discount rate? In this case, I'm saying WACC is my discount rate, but it might be my required return as an investor. It might be a hurdle rate. It might be however I value money in my experience. Do I probably have a sense of it? Yeah. Sadly, I know this too, right? It's gotten very easy for us. This is now 21%. Period. Okay?
What do you, what?
What?
21%.
So that's the case.
The Trump
Yeah,
administration.
as of January 1st, 2018, corporate federal tax rates are 21%.
For all companies?
All companies, across the board, all income
21,
levels.
wow.
Wasn't it at 35?
Yeah.
Well, it was scaled. It was scaled. It started at 28, went all the way to 35, backed off to 34. So it's scaled.
Should we, like, in a problem, should we just assume that from now on, or no?
No,
It's given.
because some of your problems
Are
are
based
from
on-
scenarios dated in the past.
Gotcha,
Okay, and I purposely kept those because I want you guys to have to think about applying numbers to tax tables, because personally I have no confidence that the 21% flat rate will be persistent. In fact, every time our House and Senate have simplified a tax structure, within a period of years, it has become modified. And that's usually 3 to 4 years max. So, if I know all of those things, I can now reverse engineer this puppy, and we're not going to spend the time to do it today. We are going to do it, I think it's next week. So we have 3 weeks, including tonight, right? And you guys are marking them off.
Yeah.
Count the days.
Counting them down. It is such a boost to my ego and self-confidence to spend an evening with you, let me tell you. Len's been working on it. Len and a few of you have worked on me for like 3 different semesters now.
Straight.
That's right. Semester after semester. I used to be about 6'4" and trim with a lot of hair, okay? And then I met Trump. Yeah, you're gonna smack me around in class. Okay, so I can take this and I can figure out some G. And maybe that's going to be a real interesting G for me, and we'll talk about it more in the I think it's next week. Okay.
Great.
Yeah.
Just quick question, do most companies have, like, make investments or have invested capital? Because I feel like, wouldn't that be
Do most companies have invested capital?
Yeah.
Yeah.
Yes,
like
virtually all. So you're a lawyer, okay? And I think a law firm is amongst the least capital intensive, physical capital intensive firms I can think of. You have some desks, you have some computers, artwork, pens, you know, you got briefcases, software, okay? But the money to buy all those things had to come from somewhere. And once we thought about that money and then bought those things, we had invested capital. And it came from, we borrowed it, or from your savings, or you got stock investors. So that's the least capital intensive firm.
Gotcha.
Now think back to Central Camp Railroad, which is one of the most capital intensive types of companies I can think of. Railroad companies, you don't create a dime in revenue unless you've got hundreds of millions of dollars in rolling stock and rails and property to put them on, etc. So
I just-
all companies.
I was just looking at it wrong. I was thinking more like shares and bonds and all that.
Got it.
And that's where I was like not sure.
Think of it this way, fixed assets and net working capital. See, this is one of the reasons I like the operations approach. It's harder for us to visualize debt and equity. It's easy to visualize fixed assets, this building, and benches, etc., and net working capital. I'm going to go to another room real quick, see if I can actually find an eraser. Can your arms do that?
Sometimes,
Okay, there's probably like 5 of them down there.
yeah, among other things.
Yeah. Some of them might.
Hold your legs.
Just go down.
Is there a stick? Well, never mind, we got it. Is there a stick over there?
Yeah.
See, why didn't you guys tell me that half an hour? You're just mean spirit. See? This is something the land devised.
That's where this stick came from.
I attacked first, that's what you said.
With all this.
I'm one of the nicer guys you're going to deal with during the next
You're
couple
giving
hours.
us all this formal, mean form. Yeah.
Okay.
The pit of despair.
Now sadly, all we've defined is one of the many inputs for the forward market multiple model. Help me with the other. Visualize the model for me.
Aaron's trying to solve my.
No, don't go back to your notes. Just think. It's a model. In its most simplistic form, what do all of these models look like? And they're most simplistic. So the value is equal to the present value of some discounted cash flow plus the present value of some continuing value, right? That's the simplest we can break this thing down. And the present value of the discounted cash flow then is going to be the sum of the, and I'll say free cash flow at times I being any period, divided by 1 plus some discount rate to the exponent of time. And there's one of these for every year of our explicit period for which we have a discounted series of cash flows. And then we have a continuing value that in the case of the forward multiple model is EBIT at time 1, that's continuation time 1, times whatever our multiple is. So we have to talk in a few minutes about other ways of thinking about the multiple other than having observed it or gotten comps. And the present value of the continuing value is simply that continuing value divided by 1 plus whatever our discount rate is, again to the power of time. The only difference between the forward market multiple model and the free cash flow model and the KVD model and the adjusted present value model is in the notation of the continuing value. Now the adjusted present value model has another cash flow for which it has present value of discounted cash flow plus present value of continuing value. Okay? Every one of these is the exact same structure. Every one. Okay?
For the continuing value, EBIT 1 is your EBIT in that continuation period based off of your multiplier or your growth rate?
Well, it's the EBIT based upon some forecasting of EBIT, which we're going to spend most of the rest of our time together forecasting tonight.
Okay.
Yeah. Because we're now at a point where we've used this enough where somebody's got to ask, where do these numbers come from? Well, we're about to put them together. Bless you. So the value is simply the present value of some discounted cash flow and the present value of a continuing value. And the only reason that we separate a discounted cash flow period from a continuation period is because we think we have different rates of growth in those different periods. But if we have the same rate of growth if we can generalize this as just some G in perpetuity, we don't even have to mess with the present value of the discounted cash flow. We go straight to the present value of the continuing value, don't we? Which is why Kevin O'Leary can say, well, it's our cash flow times X, or M, to give us what this company is worth. Why is it that these guys on Shark Tank go nuts whenever they find out there's any reasonable amount of debt in the company? Somebody's borrowed money.
Because if they're seeking capital, they're already in debt. That'd be my guess. I don't know.
Well, it is, but what is it about that, Chris? So think about this, again, and I bring us back, and you're going to say, well, of course, we know this. When we're identifying a value, we're identifying that which it would take to acquire the rights to all the future cash flows.
Somebody else owns the rights to those cash flows.
If we're in debt, somebody else owns the right to some of the cash flows. And so if I'm just trying to buy stock, I gotta think about that. It adjusts the value of my stock, right? Okay. It's now the value of my stock is only the value of part of the cash flow. It's that which I have not already committed elsewhere. And in early stage companies like this, it makes all the difference in the world. In all companies it does, but especially in early stage. Okay? Well, come back here. I've said we can observe it. So if I know the enterprise value at a point in time, and if I know the company's EBIT at a point in time, I then know the EV/EBIT multiple. Well, how do I know the enterprise value at a point in time? Well, maybe this company at a point was in the public sphere. It was a publicly traded firm. That's not very likely, because if it was, and it's still an interesting company, it probably still is in the public sphere, and I don't know what we're doing this for. Okay? Or, at some point, it was valued by another investment. Chris wants to say, yes, I know what we're doing this for.
Companies demutualize all the time.
Pardon?
Companies demutualize all the time.
Well, yes, but not a very big number of them. It happens every day, but it's a small number.
Insurance companies do, well,
They used to.
yeah.
Yeah. There's another reason we might make an investment decision too, but we're going to come back to that in a week or so. So I can observe it through market activity, but if I am doing that, then I'm not sure why I'm valuing this necessarily, because the market's done it for me. Or I can say, well, here's Cam's company, and 2 years ago, he hired a valuation firm, and they came up with a then present value, and that then helped us set the EV/EBIT multiple. And if that was then, if it was 10 then, we have every reason to believe it can be 10 now, right? We can look at other companies in the market, so we can look at comps. Comparable transactions or public comps and present transactions. But we also can think about it aspirationally. And this comes back to the recognition that that multiple in both the numerator and the denominator is a function of G. So when Matt talks to me about his company's multiple, he's actually telling me something about the growth expectations for the company. In fact, it's one of the most important things he can tell me about the growth expectations of the company. It's one of the most universally understood things he can tell me. Okay? A multiple of 3 suggests a relatively low growth. A multiple of 10 suggests a fairly robust growth. A multiple of 35 suggests a wow growth. You know, Roadrunner and Wile E. Coyote kind of thing going on, right? By the way, how fast does a Roadrunner run and how fast does a Coyote run?
55 miles per hour and 75 miles per hour.
Well, he always gets hit by an anvil, so it doesn't matter.
He always gets hit by an animal. Coyotes outrun Roadrunners all day long. All day long. The only thing a Roadrunner's got is it starts off the line faster because of so much light. Roadrunners run at about 10 to 12 miles an hour, and Coyotes can run at about 30 miles an hour. You want to know how I know that?
How?
My wife's father had a PhD in plant physiology, and taught at Arizona State. And
Yeah.
when he moved down there, he was all about roadrunners and coyotes, because he had 7 kids at home watching cartoons. Okay?
I'm a Sun Devil
That's
dude.
why I know this. All right, so aspiration, and it's about G. So let's assume for a minute that in the past we observed this company has a multiple of 4, and its peer group by comps have an average multiple of 6. Some of them, by the way, the best run of them, have multiples of 12, and some of them have multiples of 4 also, because it's one of them, right? So Harry, you now are the CEO of this thing. We are the board of directors, and we represent all the rest of the shareholders, including ourselves. What are you going to do for us now, brother? How are you going to grow our company? What are you going to do in terms of a multiple for us? You going to give us 4?
I gotta give you at least 6.
If you don't give us at least 6, I don't know why we hired you instead of just somebody else from the herd, right? If you're going to give us 4, because you know the company can do 4, if you're going to commit to 4, then I'm going to say, oh gosh, we made a mistake. And hope I get to that contract before the ink dries, okay? You're probably going to say, you know what, I don't think that the scale of this company is such that we can reasonably expect a 12. 12 is kind of an outlier. 12 is something that the biggest, most dynamic have done. And it's going to be a long time before we have that scale and the cold cranking amps to be able to get there. But we're going to work off of a multiple of 10. In fact, you're willing to have your compensation bonus be based upon what kind of multiples we can drive for you, that you're going to be able to drive for us. Okay? So we're going to have all of our interests nicely aligned. Just like it's hard to know what G to use, it's hard to know what multiple to apply. Please, Mary.
But it's sort of subjective.
Not sort of.
I mean, it is. So, because, like in the formula, the continuing value is EBIT times the multiple.
Yeah.
So
Which
it's
one?
so it's just based on what you believe the continuing
So,
value is.
Mariana, you know that that multinational enterprise thing that we talked about that was yours a few minutes ago? We need to just have a brief private conversation that it's just you and me, nobody else is hearing this. Now, I really respect, I'm thinking about buying your company, and you're going to accept my offer. You're just going to. Here's why. Because you're going to keep some of the stock. You're going to take some cash. You're going to keep some of the stock. I'm going to make you wealthy. I'm going to make you wealthy partially because I'm about to give you some millions of dollars that you don't have access to liquidity today. But I'm going to make you wealthy because I'm going to bring your little company into my multinational global conglomerate. And you're going to have access not only to my customers and my markets and my innovation and that contract I have with Madison Avenue, a marketing firm, but you're also going to have access to my capital. You're going to have access to me. And I grew this company from nothing when I left the Greek islands with nothing but my shirt. Okay? All right? I'm going to make you wealthy. I'm going to pay a little bit more than your 4 times because I think it's worth it. That's goodwill. I'm going to take you to 10. I'm going to make you wealthy.
She said, I'll take it, okay?
She's convinced.
I like you fully.
Right? I don't know what the hell I'm talking about. Right? So this is the point. You're right. It's totally subjective. And as Mr. DeMotor and Dr. DeMotor would tell us, I just gave you the story and you bought it hook, line, and sinker.
I
By the
totally
way, I
bought
had a
it.
fascinating discussion with him. Yeah, let me finish this a little bit and I'll tell you a little bit about it.
Creating
So,
synergies here.
pardon?
Creating synergies here.
Yeah, we're creating synergies because we're doing business in China, and there was one other. What was the other one? There were 3 things: synergy, China, and the blockchain. The blockchain. We're going to do it on the blockchain. Okay, that's the other one. That's the other buzzword. that increases our business value. So what we just did was it's absolutely subjective, but I gave you reasons to believe that we could achieve this. That one's aspirational. Do I think I can look at your company and find some efficiencies? Well, maybe so. Maybe not. Maybe it, Bob's saying no. I'm not going to look at his company finding efficiencies because he's run it perfectly. You couldn't have timed that better, by the way. So maybe so, maybe not. Maybe I can't find efficiencies, but I bring some best owner premium to the table. We're going to talk about those a lot in the second half time. A best owner premium. Maybe I'm a better owner of your company than you are because of my access to capital, my access to global markets, my blockchain China synergies, okay? Maybe I'm a better owner than you are. Doesn't mean that you're a bad person, doesn't mean you're not a great manager. You just don't have $7 trillion in your sovereign wealth fund, okay? Okay. Is there anything we discussed last week that was new that we haven't just rehashed? I don't think so. Other than I recall last week coming to the realization that Cam is a better instructor than I am. No, it's okay. It's okay. Because frankly, so it's okay.
He thumbs it down.
Probably not true, as it turns out.
Adjusted for the
Well, that was rehashing from the week before.
Oh, yeah.
Yeah. Yeah, I'm always happy to go back and talk about the prior week, but hopefully, once we've talked about it twice and you've done problem sets on it 2 or 3 times, we don't have to talk about it again. Okay, so it's a quarter after. Let me tell you about Aqua Motoring, and then we're going to come back and we're going to do a exercise together, and then we're going to move forward. So here's the interesting thing. You guys have seen him on video, and he's the exact same guy sitting down having breakfast. I have legs and problems that weigh more than he does. Okay, he's just a bit of a thing, but he's very conversational. He's extraordinarily confident. In fact, my guess is in some circumstance, in some conditions and scenarios, he maybe would be thought of as arrogant. But me too. So it worked. Right? No, really, I am. I know you can't imagine that. I have an ego the size of Montana. So he wanted to keep bringing the conversation back to what are we talking about in classes? What are we doing in research? He wanted to talk as much as possible about private equity transactions that I've been participating in, and talk about companies that myself and students had valued. And I didn't want to talk about any of that. I had an agenda too. And he was trying to exercise his agenda and get every tiny piece of information he could. And I was doing the exact same thing. So every time I get a word in edgewise, I brought the conversation back to my agenda was to discuss the functional difference between a fully market-based opportunity cost, WACC, and a quasi-market, quasi-book-based, which is what most of the industry uses, including some of his material. So, and as you guys probably know, there's very little that I say with respect to transactions I participated in because of non-disclosures, non-competes, etc. But, we've had a really interesting discussion about that other stuff, but every time we came back to this, he said, if you can find it, if you can calculate it, the market-based cost is the cost to use. But he every time prefaced it with this if. If, yeah. Which if it's a market-based company, it's in the public sphere, easy to do, right?
No.
Pardon? Well,
It's not too bad.
it's not too bad. I mean, we can find data, we can calculate it, or we can just go to Google, Yahoo, Finance.com, right? Or
Check that though on every different site, they're all different.
well, I know that, but that's a problem of yours, not mine. Just like how you valued Apple is your problem, it's not my problem, right? That's what he was saying.
I'm just telling the right story.
So, good point. So we agreed that the hardest part was in valuing the market value of debt. It's the market value of debt. Because companies will have sometimes well over 100 debt offerings out there. General Motors has more than 100 public debt offerings, all with different time frames, all with different coupon rates, all with different exercise or payment schedules. As it turns out, some with different credit ratings and such. And so that's the hardest part. And he knew, because of some homework that he'd done, that we had led a group of students over 2 different summers analyzing all the market value of debt for all the companies in the S&P 100 and the Dow 30, and thought that was kind of cool, and then picked it apart point by point. Yeah, but he was kind about it. So it was just really interesting. But what was really interesting to me more than anything else was he had his agenda, and he was relentless about it. And I had mine, and I was relentless about it, and we had a good time. It was okay. Yeah. Smart little guy. I would not want to come up against him on Jeopardy. Smart, smart, smart. All right, let's take a brief break. Let's be back in here 7:30, and let's move on. And if you're back before 7:30, I'm okay with that.